Good day, fellow investors. TORM stock analysis, a highly requested stocks for me to analyze because of the high dividend yield and because many videos out there on YouTube discuss how it is Howard Marks' biggest position. It's not his biggest position, it's his biggest mistake. That turned into a position. More about that in this video. And when it comes to the stock analysis, why invest? Huge dividend yield, higher net asset value per share than the stock price, great return on invested capital, high margins, high dividend payout ratio, and they are a global pure play tanker company with a modern fleet of around 90 vessels that get paid to ship oil around the world. Now, all looks great, the numbers look great, the P ratio is, 2 point something, the dividend per quarter is 1.2. Keep in mind the stock price is 20, so that's 25%. And the short-term factors for the tanker sector are positive, geopolitical, idling of Russian exports. The ships need to go around the world because of issues here in the Suez Canal. But the dirty tanker index has been declining, thus there is more supply and the shipping routes have been reorganized, and now we have seen great times for companies like TORM, and now things are slowly balancing back, perhaps even to the normal, and that is the risk and reward. If things remain in an elevated situation, big dividends are the result. If things return to past things, then it will get ugly. And if I look at the Clarkson's average tanker earnings per day, you can see how TORM has been making a lot of money here, and that is why you see the highest dividends. But the market also understands the risk, and that's why the dividend yield is 24%. That's a huge yield, and as long as the market remains at supportive levels, things will look okay. But if things turn, then it gets ugly. And as the prices for tankers are higher, you can see here how the order book as percentage of the fleet goes higher, and you can see the years when it was higher. After these years, there was a slump. When the order book was very low, after these years, there was a boom. And that is how a cyclical environment works. Now, shipyards depends on what they're going to produce, depends on demand, depends on who pays more. Values, vessel values to net value, the values also depend on the prices. Here ships are very cheap, here ships are very expensive. So that's also something that compounds the cyclicality of this business. And you can see here also the prices of ships and how those prices go up and down, the cost of new builds as prices are higher, etc. However, the company has a good payout ratio. It focuses on delivering value to shareholders. Nothing wrong about that. The outlook has been lowered a little bit, and now we'll see on the future will depend on prices. The dividend is huge. Will likely be a little bit lower if things stay as they are now. Q4 2024, there is that, of course. And if you want to have some exposure to the tanker sector, there is nothing wrong with TORM, but I have to show you something more. So it has been listed on the Copenhagen Stock Exchange in 1905, all right? And then it went to NASDAQ New York 2017. New builds, shipping, UN global contract. No mention here that they went bankrupt here. Okay, maybe they forgot that. You forgot those things. And Oaktree is the largest shareholder, but not because Howard Marks went in and bought it. It is because the company went bankrupt, and Oaktree Capital and other TORM creditors acquired a 99.2% stake in the shipping firm for $1.3 billion in a debt for equity swap. The debt was 2 point something billion, so at least Oaktree got something back there. So it's not like they bought it. It's not Howard Marks' biggest position. It's his biggest mistake, as he bought the debt and then the company went bankrupt. And he's trying to salvage some of the 1.9 billion of debts from the situation. And that is exactly how shipping works, and that's what I want to explain here. First, my fellow fisherman worked on a ship for 30 years, and he said his teacher was saying, in a good year with 3 voyages, you pay your ship back. That's the good times. Then companies pay huge dividends. The ship owners put those dividends aside. In bad times, you go bust, and the ship owners buy back the ships at 10-20% of the production value. That's the cycle of the shipyards. Retail investors very often get screwed. You need to hope for the dividends to cover the investment before it gets to a loss. Time the in and out really well with the shipping factory and keep it on the risk side of your portfolio. That's what I would say. And you can see this chart is from the Danish stock market. This is what happens when things in the shipping cycle reverts. It's fast. Look at this. Boom. And maybe you get 10-20% dividends, but it's usually not enough to cover from the losses. Plus, the company pays huge dividends and then keeps issuing shares for specific deals that you as a small shareholder are not capable of doing. That's also something that I am not going to dig deeper, but you have to understand and see how much is that of a cost, diluting shareholders, at terms, issuing shares to management, to this. That's always something behind these shipping companies, and then they go public on the NASDAQ, on the this, on the that, and except for Maersk, it's a different managed company. And then you see the real shipping industry, the real yield. These are all high risk, possible also high reward. If there are more geopolitical tension, this and that, you get 20-30% dividends for 3 years, you're covered, and everything else is upside. But if not, then the stock crashes, and not even 50% dividend can save you. I'm not making predictions, I'm just explaining the risk and reward so that you know how it can fit your portfolio, because a lot of retail investors asked me about this. Hope you enjoyed this, thanks for watching, and I'll see you in the next video.